The shares of Tesla are sliding today and down 5% for the week. Joining us now is John Murphy. He's senior auto analyst at BofA. John, did I get that right? You raised the price target almost $100, but downgraded it to neutral?
Correct. Yes, there's a fundamental call here and a stock call going on that we can talk about. But at this point, we think a lot of the good news is reasonably reflected in the stock. And the 490 is our fair value on a sum of the parts basis, and we'll look for an entry point potentially lower than it is right now.
So, and we can where are we now? We're at 397. So $100 of upside sounds like okay. So just
Correct.
Break this down. It sounds like almost a buy call, but it's not.
Well, we're positively predisposed to the company and the potential value it will create over time. But remember, we upgraded the stock when it was about $170, and that was less than a year ago. So it's an incredibly volatile stock. So I think as we work through the course of this year, there's some execution risk that has really not been taken into account in the stock at this point. So there's a couple of things. First, they need to launch a low-cost model and then another model in the second half of the year, or 3 in the Y derivatives. They also need to get FSD moving in the right direction as far as increased subscribers. They need to launch a robo-taxi fleet sometime in the middle of this year on a testing phase. So there's a lot to get done, and we do think there is some potential issues with hiccups along the way that might pressure the view on growth in the near term, and that's why we went to a neutral.
Got it. So this to you is about execution risk on those major initiatives that they need to deliver?
Correct. I mean, on vehicle launches, there's probably the greatest risk. I mean, that's something that historically the company has had a hard time with, as there haven't been that many new vehicle launches. So this is somewhat new to them, of the XX, 3 and Y, and then the Cybertruck. None of those have gone that well in the past. So I think that's probably the first level. I think the second level is really around FSD and the recognition by the consumer of the value. I think once you've driven an FSD 13.2, paying $99 a month is kind of a no-brainer. But getting that out there in the market and advancing that technology to full autonomy, which is what you'll need for robo, may take a little bit longer than people are expecting. So I think on the hardware side, you might have some small disappointments. This does not change the story mid to long term. And then on the software side, you may have some misses relative to expectations as well.
And you're also talking about how if they were to do, for instance, a capital raise, that would be a positive. I mean, I know it might be a near-term negative for the stock, but it's interesting to say that even a step like that might be necessary to kind of tackle some of these launches.
Well, I think put it on your CFA hat as you just did. 5%, capital raise is what we kind of think the ballpark could be. That's 5% dilution. That's not necessarily good for a stock. But if you're raising over $65 billion in equity, which would be the largest capital raise in history by far, and using that money to ramp up your compute power and your capability around FSD, and then your new product launches, I think most growth investors would like that, and for that reason, I think the stock could be bid up on that. So when we're looking at sort of the puts and takes in the year, that actually could potentially be a real positive if that were to occur.